Today we will cover the fourth company in our deep dive series. This company has over 5 decades of industry presence in India's auto ancillary segment, and you can find the related links and sources in the comment section. As Peter Lynch said, if it's a choice between investing in a good company in a great industry or a great company in a lousy industry, I will take the great company in the lousy industry any day. Today, we will discuss a company from such a sector which is considered widely as a sunset industry. The company is a manufacturer of internal combustion engine components. From the lineage of Shriram Group, Shriram Piston and Piston Rings is a leading Indian manufacturer of piston rings, piston pins and engine valves. The company has a dominant market share in the segment with many reports indicating 40 to 45% market share. The most interesting thing about the company now is one of its recent acquisitions. It has acquired 66.42% stake in SPR EMF Innovations Private Limited to enter the electric vehicle ecosystem, which will be one of our key focus today. Even though the company is said to be operating in a sunset industry, the company has been able to increase its sales from 1,393 crores in 2016 to 3,550 crores in 2025. The standalone quarterly sales of its ICE segment has increased from 636 crores in December 2022 to 855 crores in March 2025. During this period, the company has been able to maintain stable operating margins, reaching 22% in March 2025. Part of this growth could be attributed to BS6 transition, which resulted in higher market share with key OEMs in India. Higher operation efficiencies and increased production also helped the margins. The company's increased focus on aftermarket segment also could have helped. The company caters to the entire auto spectrum of two-wheelers, three-wheelers, passenger vehicles, commercial vehicles, tractors and gensets. If you look at the above excerpt from the company's investor presentation, almost all the companies that would come to one's mind in each of these segments are company's clients. In addition, the company also has supply agreements with OEMs who supply to international players like Volkswagen, Jaguar, BMW, Caterpillar, Babco, Suzuki, Kubota, etc. The domestic revenue for the company has been increasing continuously over the last few years, and the aftermarket segment currently contributes 26% and exports contribute 17% of the revenue. Shriram Pistons has a history of long-standing technology partnerships with major players. It has a partnership with Schmidt Germany for pistons, Raiken Corporation Japan for piston rings, Honda Foundry for pistons for Honda vehicles, and Fuji Japan for engine valves. The company has paid a royalty of 1.6% of revenue for these technology partnerships in the last year. Let's have a quick look at the shareholding. Promoters currently hold a stake of 43.75% in the company. An interesting public shareholder that has exited its stake recently is Schmidt, which exited the stake in December 2023. As they were one of the oldest technology partners, I wanted to find out why they exited the company. Raiken Corporation is another major public shareholder with 21.30% shareholding in the company. Schmidt Pistons was owned by a German company, Rheinmetall. In December 2023, Rheinmetall sold this business to Committance Capital AG. So it can be said that the stake sale has nothing to do with Shriram's Pistons, but can rather be seen as Rheinmetall's strategic shift of focus to the defense sector. The company is also working on alternate fuel solutions like CNG, hydrogen, flex fuels, etc. It's interesting that the company was the sole supplier to Bajaj CNG bike Freedom 125. They're also working on alternate solutions like hydrogen. As we discussed earlier, the company has a history of growing its business through successful collaborations. In fact, all its major products were developed through collaborations, and all of these major collaborations happened between 1972 and 1993. As you can see from the journey, after the initial period, there were no major product additions in a few decades. This was more like a period of consolidation. But since 2023, the company has started becoming more aggressive and has made 4 acquisitions so far. In 2023, it acquired 66.42% in SPR EMF Innovations Private Limited and 62% stake in SPR Takahata Limited, followed by a 100% stake purchase in TGPL Precision Engineering Limited and 100% stake in Karna Intertech Private Limited. Before we go in detail into these subsidiaries, let's see how the company is able to make these acquisitions. If you look at the company's balance sheet, the cash and equivalents has grown from 100 crores in 2016 to 1,052 crores in 2025. The company has a total borrowing of 508 crores, most of which is short-term borrowings at 305 crores and long-term borrowings at 174 crores, making the company net debt-free. Also, short-term borrowings are covered well by inventories and receivables. This means that all the acquisition that this company is making is out of its internal accruals. Now, let's focus on one of the major areas of our today's discussion, the acquisition of EMFI. The company manufactures motors and controllers for the whole range of electric vehicles from two-wheelers to medium and heavy commercial vehicles. Since acquisition, the company has added additional capacity and the new plant is expected to commence production in June 2025. One of the major reasons for the initial growth of electric vehicles in India was incentives. As per the latest PM Electric Drive scheme, electric two-wheelers will be allotted an incentive of 5,000 per kilowatt hour, capped as 10,000 per vehicle. And there are incentives for three-wheelers, e-buses and ambulances as well. Notably, four-wheelers are not eligible for incentives this time. These schemes may help increase adoption of electric vehicles, especially in the two-wheeler and three-wheeler segment, which should help Shriram's electric drive business. As per the phase manufacturing program for electric vehicles, manufacturers were obligated to follow certain localization norms to be eligible for support under the FAME 2 subsidy scheme, which means certain parts must be manufactured locally, tested and assembled. For flouting these norms in 2022, the government had asked some of the electric two-wheeler companies to return subsidies totaling 469 crores and barred them from making future claims under the scheme. Hero Electric was asked to return 133 crores, Okinawa Autotech 116 crores, Benling India 48 crores, Ambier 124 crores, Revolt 44 crores, and so on. Among these, AMO Mobility, Ampere, and Revolt returned the subsidies with interest. There was a recent amendment in March 2025 to the phase manufacturing program for PM Electric Drive scheme. As per the amended PMP guidelines with effect from May 1st, 2025, the traction motors and controllers for two-wheelers and three-wheelers need to be manufactured locally to be eligible for incentives. And for e-buses, the PMP guidelines for localization for traction motors and controllers comes into effect after 6 and 12 months of notification. Both places Shriram piston at a sweet spot. Along with localization norms, they need to obtain certificate of eligibility assessment from recognized testing agencies. As per the company's management, they already have all the required ICAT approvals in place for both motors and controllers, and they also have the required localization. As per the company's third quarter con call, the company also mentioned that Ampere's new vehicle was launched with the company's hub motors and controllers. Now, coming to the second subsidiary, SPR Takahata, the company has a 62% stake. It has technical collaboration with Takahata Japan, which is a leading precision injection molded parts manufacturer globally. Also, with this acquisition, it has access to a different set of customers, and the company has plans for expansion of this business. The third acquisition, SPR TGPEL, is another precision engineering company with a portfolio of auto and non-auto products. It has a different set of customers and is complementary to SPR Takahata's products. Final acquisition, Karna Intertech Private Limited, is more like a backward integration which produces high precision dies for the company. With all these acquisitions, the subsidiaries currently contribute 13.5% of fourth quarter consolidated revenue. Let's have an analysis of the key risks. The main risk in this business is obviously ICE engine obsolescence. The bulk of the revenue for the company is from ICE segment. There has been some diversification, but the other subsidiaries will not be able to make up for this. However, the ICE segment sales are still strong, and there is also the large aftermarket segment. The second risk is the cyclical nature of the auto sector. Even though the company is able to increase its market share, being a dominant player with huge market share, the sales will be dependent on India's automobile production trends. If you look at the auto production trends, after 2019-20 peak, it took a few years for the markets to reach the same production figures. The same reflects in Shriram piston sales as well. The third risk is regarding the company's margins. Even though the margins are great now, as the underlying sector is cyclical, so the company's margin could fluctuate as well. The company's annual margins did drop as low as 11% in 2020, even though that may be an outlier considering the unique situation. We are at the highest point in operating margins for the company, with margins touching almost 22% in the last quarter. Any reduction in margins would have a proportional impact on profits as well. However, the company is showing very positive trajectory in terms of quarterly profits. With India having a very good agricultural harvest, we may see good growth in two-wheeler sector in particular. The fourth and final risk is regarding the many acquisitions the company is making. The company has made 4 acquisitions in last 2 years and is open to more acquisitions. So far, it looks like company is making value accretive ICE agnostic acquisitions. But any large acquisition that the company can't handle would be a huge negative. To conclude, the company's major business is in internal combustion engine segment, which is widely considered as a sunset industry. However, this could be a moat in itself in the sense that there may not be any new large competition or capacity that may come in. Even capacity additions would be proportional to the growth in the industry, thereby protecting margins. The second largest player in this industry is Federal Mogul Godse, which has a 29% market share as per latest Square ratings. Also, they have improving margins and is net debt free, which shows that the industry is not as bad as it is perceived. Secondly, exports for the company declined last year. Europe contributed to 31% of the export revenue, and slowdown in Europe could be the major reasons for this reduced exports. A similar trend is visible in many Europe-focused companies. However, the company has been able to make up for a part of the lost exports by entering newer segments like snowmobile applications, marine applications, compressor applications, and lawnmower applications. And the company expects to see increased sale from these segments, helping exports next year. Thirdly, as we already mentioned, the localization norms of PM electric drives should help the company's EV subsidiary get more orders from the two-wheeler and three-wheeler segments. The cross-selling opportunity that comes from having a very strong customer base and complementary products will help further. The company's strong balance sheet and net cash position will further help the company in expansion as and when needed without raising debt. Finally, as you can see from the above figures, it is clear that most of the ICE engine component manufacturers command cheaper valuation in comparison to other auto ancillary companies. I wouldn't say that these are perfect peers to compare, as they are not. But if you look at some of the other metrics like operating margins, sales growth, they are actually better for Shriram Pistons than many of these companies. So if Shriram Piston can use the cash flow from its ICE business to build the EV component and ICE agnostic business, we believe that this would help the company in building this valuation gap to a certain extent. Hit subscribe so you won't miss our updates.